Thank you, Daniela. It's a pleasure to be here with all of you. Already reaching the end of this project. This has been almost a year of very beautiful things. We have learned a lot from all the entrepreneurs and their businesses. And I think we have given feedback to all of those activities. So in the mid and long term, they can enjoy of a better growth and social impact for all. So I'm honored to have this last speech. And I see that we are not such a large group, so that might offer me the possibility of having more questions or conversations. And the idea here is that everything that we have been working ultimately ends up becoming real when one has enough resources to be able to invest and achieve growth. The difference, digital businesses, the difference between digital and traditional businesses is that digital businesses seek for an explosion or for an exponential growth in the short term, while um, traditional business in which one invests, works for many years, and after 20 or 30 years, you see the growth and the results. But in the digital business has the possibility of having scaling. So scaling is that I can have a market or a system market that it was not possible before without the digital concept. Now, with digital technologies and tools, I can reach a much broader population that is going to consume and is going to make my income to become real and to grow and be more attractive for investors in a shorter term. And ultimately, I think we talked about this with the ones who were in the previous class. Uh, businesses, in essence, for an investor are the same. It's about if they generate or not added value. So we're going to see that it's not only about money, but it also includes different aspects of social and environmental and equity impacts that is very important to take into account in the businesses. But in economic terms, a traditional business well, and to both the traditional and digital businesses, uh, from both we expect a return, but the way in which or what we do to get them is different. Uh, it's usually by investing important amounts of money in order to have returns 5 or 7 years instead of 30 years after that in the digital ones. So in order to achieve this, there's a whole process to do it, which is basically to to raise how can we acquire raise resources from the market, and which are the steps and protocols that we must take into account to be successful in that process. So what we are going to talk about today, I'm sorry, I'm going to move the slides. Today we're going to talk about how can I don't see your cameras. So please, if you have any question, just raise your hand or over your mic. So how to approach this world that is kind of unknown if we have been devoted to our production, our services, our products. Maybe we do not see the world of investors that is a more financial world, more perhaps sophisticated with words in English that might be unknown, but it's, the technical argot that one must understand, and it's not that hard. So what what do we mean when we are raising money? It's about making an investor fall in love and believe in our business. So it's another sell, it's to to name it, to say it in simple words, to raise money is to sell something. You sell your services, you sell your products, you sell your businesses like love, their love to for the company and for growth. you're selling all the time, and finding investors is the same, to go and to use the tools and languages that those investors use and go and sell them the business and the ideas, and that they believe in those ideas. Okay, so where to begin with? Well, something very simple. This is a very simple presentation. It's not very sophisticated. Anybody can understand it. And the first thing is that there is a language. There is a language we have to know in order to go and raise money. It has to do with financial topics that ultimately is to translate our need of money or of cash to grow as we want. And in order to be entering into that language and to express it, the first thing we must be very clear about, and that we have been working on all this time, is to clearly understand the business that we are in, understand the market, understand the players, understand the added value that I am putting on top of the table, and the capacity of growth that my company has. And this is something that I have to know how to state it, like in a very simple way, like if I was explaining it with clay, with Play-Doh, so any investor can understand it, because they're not going to give me money just for the fact that I have a business, but I have to be able to show the added value. What is disruptive about my business, and why are there going to be customers interested in consuming, and why my business is going to add value? And we need to learn how to explain this very well, because sometimes we find business people who are not really able to transmit what they do. So that's a key point. The another key point is that once we are clear about our business and what it is about, we must give it a value. So in a former class in which I participated, we talked about the most rigorous technique that is called discounted cash flows. And that one is usually used when we already have a lot of information of the company, but we often face the reality that we have a new business. We're just starting to grow, and we have some good ideas, but they are not still translated into cash flow. So how do we value this company or assess the value? So we're going to talk about 3 or 4 other ways to provide a value to my business when I still do not have enough information or data in order to find the precise estimate of its cost, of its value. If I go to the market to ask for money, have to be clear about how much I want to ask and how much am I willing to give of my company, because there are 2 ways to raise money, one with debt and another one with equity or investment capital. Um, but in the early stages of a startup, operating based on debt is very complex because the debt must be repaid. And when you are in a business that has still not does not have a historical track, in order to repay the debt, it is difficult that you will get a loan. So the first option that you might have to grow is to seek for investors that are willing to invest risk capital. If the things uh, come out good, they will obtain their dividends in the future, and if not, they will just lose the investment. But they are going to ask for a percentage of the company in return. And we must be clear about what is the relationship going to be between the money that they invest into the company and how much are we willing to give them in turn as a percentage of the value of the company. So once we take that into account or have that in mind, we must start to know the ecosystem. The ecosystem means which are the steps to go out there and be good looking and attractive, uh, so people will invest more on me. So there is an ecosystem of investors and an ecosystem of companies that help design the business plans and assess the values of the company. And there is an ecosystem of accelerators that are companies that say, okay, before you go out there to seek for money, please be with us 4 or 6 months and we will potentiate you. So those minimum viable products and all of the products make more sense and are much more um, developed. and offer higher business value, and then you're more ready to talk with the investors. Now, depending on of the maturity of the businesses, you don't necessarily have to go into an accelerator. You know there are investors, you know there are people interested, and you are clear about your value, and what you go is to go out there and talk to them. And that's why the last point is to have a coffee. As I uh, the one I just received, and it means go and talk with a lot of people, you know. So that's why here in the first bullet, raising capital is a job. It's not something that happens spontaneously. We need to devote time, and we're going to receive more no's than yes, as every salesperson. It's a matter of probability or chance. When we go to sell something, the most likely is that we get a no, and that's why we usually calculate success ratios. For example, of 10 sales I offer, I only earn 3 or 2 or 1, you know. So if I only have 10% rate of success, I need to talk to 10 people in order to make one sale. So in order to attain an investment, we must talk with many investors. And and every time we do it, we will understand better how they think and what are they interested in, and what do they ask, until we have 2 or 3 options in order to begin a process of negotiation. So we must not get like wed to the first one that we meet. That when we talk with investors and I have a good business, the idea is to have different options with different investors, to negotiate between them and to make the best decision. So that's the first point, where to start. Now, what do I need to begin this? Well, I need some minimum documents. We're gonna talk about them in a moment, especially the value assessment ones. And so these documents are what I use to show myself to. And I need an initial document that is kind of a teaser, a one pager, something short that in one page I can read it, and they can read it and they can say, okay, this business makes sense, the business model makes sense, the value proposed makes sense, and the economic future and the impact upon society makes sense. And this is key, and we have mentioned it in different speeches, to have the capacity in a very concrete manner to say what your business is. And that's what many people also mean by the elevator pitch, which is in a couple of minutes to be able to tell the other person what you do with your business and why it is successful. And we must have this, and we must rehearse this many times and with many people until for anybody who listens to it, it is clear and that you can receive feedback. Often, given that we are so much delved into your own operation, sometimes it's very clear for you, but you might not know how to explain it with such clarity to the rest of the humanity that are not living next to you every day, you know. So it's very important to have that one pager, that teaser, and that pitch to show it to the investors. Now, we do not only have the one pager. Behind it, we must have an investor's deck or information memorandum, which is a document, a full document with all the details of how does your company work? What is your business plan? Which is your objective market? Which are your customers? Which are your future incomes, expectations, your needs of investment? Where actually the detail, you can find the detail for somebody who is interested to be able to go into it and understand if it makes sense, which is the logic, if the expectations are right, who are the people behind the business, etc. We're going to talk about all of this. So that's why it is a full-time task, because when I'm going to raise money, it is a serious issue. So first I have to have a sales discourse. You know, it's similar to when I have a product, I have to know how to go out and sell it, and then I have to have the service or product consolidated in order to be able to sell it. And here it's just the same. We have, in this case, the product is our company. We must make a short sales pitch and then a supporting document that supports it in all levels. So after we pass the first part of seed capital, which are usually people close to us, like family, friends, then the things becomes a little bit harder. And these are investors are people who are used to dealing with professional investments. So we need to deal with or to use their language. So that's why the information memorandum or investors deck must have the technical sufficiency that we have been offering to you in these trainings of the vocabulary and the necessary calculations in order to be able to demonstrate why my business is a really good business. And additional things that is always important to take into account are having a non-disclosure agreement in which basically it is a document of confidentiality in which we are saying that we both parts agree upon that you cannot go and tell anybody this idea or steal my idea. That's key because a lot of people are taking a look at businesses and then they steal the ideas and make the business themselves. So we must blind our or sorry we must take care of ourselves legally. So we must have a non-disclosure agreement and sign it before we disclose information about the business. And afterwards, once the investors have already read the pitch and the investors deck and they say they're interested, they usually uh, write a letter of intent to show how serious we are doing the business. So it's important to be formal in your side and in their side. That can be this letter of intent can be binding or not binding, but this opens the door to a data room and the due diligence. The data room is the physical or virtual space in which one already has all the detailed information about the company, detailed information such as the financial statements, the payroll, invoicing, everything in order for the investor who is really interested to be able to go and audit it and see if what they are selling me is true or if your company, what just claim is true. So I'm not coming into providing a value to the companies yet. I'm just talking about what are the things I need in order to be able to go in and have a conversation with the investor.
Bueno, perdón, es que aquí en la
And
casa.
I'm sorry, sometimes there are interruptions at home. So we need
Tener un
we
concepto
need
de
to
valor
know our business. We need to have a concept of and or an assessment of the value. And when we start to talk with people, we must be prepared to show this formalism, to tell them, yes, I'm here. I know what my business is about. That's why I'm offering a pitch and a one-page teaser about it. And additionally, I have information more in depth, 20 slides presentation where you can understand my business in a better way. Now, if you want to know more, I have this in this data room, in this virtual data room, or in these files. I have all the information open so you can audit it and understand that what I'm telling you and what has happened with my business in the last 3 or 5 years or 6 months is true and where I am directed towards. So I'm ready to start a negotiation. So if you have any question, let me know. And like these are the basics. And now we're going to move into how do we pose a value or determine the value of our company and how those investors think. So in order to start to understand my business, I have to know where I am, where I am. And here with all the people that have been in this training or this process, we have had people. Not all of them are in the ideation part because part of the filter of the program was that they already had some years of experience and capital formed. However, we can have new ideas because that's what digital topics are about. We can think about them and have ideas and innovate. So we can be in this space of ideation or ideas where I am creating the business, but I already must have a minimum viability made where I am making uh, experiments and I am making it work and it's an early momentum. And then in the third part, I am already in growth. I have important sales level or I have already tested it and I want to scale it up and I generate a level of income that is meaningful when I am growing. That is a very different moment of the company. So these are these four moments. The first two moments of ideation and early momentum are moments in which I still have not demonstrated something. I'm selling more a bit for the future, a bet, and I have to have very strong data in order to demonstrate that this can happen. And I want them to believe me. And we are going to have more qualitative variables about who are the people who are behind, what is the business model, what is changing, what kind of market do I have. So the investor says, okay, that makes sense. And the other two stages are more about showing what I have done, showing the revenue. I have 1 million users, for example, or customers, or 100,000, or I'm growing. I have this, I have this cash generation. I have sold $10 million. I already have capacity to demonstrate the behavior, the scalable behavior of my business. Because if basically I have a small business that just sells $10,000 a year, and I'm demonstrating, I'm showing that I'm not growing in the last 3 years. It's a traditional business that does not have capacity of scaling up. And there are also investors who would be interested in this, but it's a different negotiation. But if I told them, okay, I have 10,000 last year, and now I am reaching 50,000, and the exponential growth is like this, and you can see what is expected the next year, we're talking about a different kind of business. So you first off, we have to know the moment I am, the moment my business is in, and based on that to build the assessment of the value of my company. And not everybody is going to agree with us. One can say, okay, I have this idea that is worth gold, but other people might say, no, that's worth nothing. And that's part of the negotiation. Some people might believe in me. No, if I visited a lot of people and nobody is believing me, maybe there's something in my hypothesis or the way my business is structured or thought. It might not be, something might be missing, but it's good, important to know how much my business is worth. Now, to know in which moment I am and to build the financial model that we talked about the last time, you must be prepared to have the knowledge that there is a technical language that must be included in this. So in digital businesses, there are many terms that are in English. The idea is not to delve into them here, but I want to mention them because it is important that you have them within your one-page discourse and also within the investor's deck or information memorandum, because the potential investors are going to say, okay, what is your market size? What is your gross margin? The margin you generate, how much does it cost to you to acquire a client or a customer? Because if we're thinking about a scalable business and say, okay, in order to scale up and to be able to have 100,000 customers. Well, each of these customers has a cost in order to acquire them. And I need to know that if the lifetime value, the LTV, is how much I am going to draw out of his customer versus what they cost, I need to use those terms in my project. For example, it costs me $100 to get a customer with all of the process of the funnel and how since the advertisement is issued, how they click on the internet website until they finally purchase. This might cost $100,000, but in the lifetime value, I am going to draw out $500. So that makes sense. But if I say, okay, acquiring a client, the customer costs $100, but I'm only going to draw 500, sorry, $50 out of them, the business is not going to make sense. So we can see that there are technical words appearing here. And beyond that is what do we have behind? If I know my business very well, I don't get scared by technical words because I say, okay, I already know how much is the cost of getting a customer and how much I aspire to get from them. And I also know the churn rate. That is basically, let me see, the churn rate is how many people leave uh, from the population that I have already harnessed. So how much people come out of the portfolio, then how much people I have to bring in again, how many customers. So if the first year I get 100 customers and 10 of them leave, I have 10% of churn rate, and I have to bring these people back, or like other people to fill that gap. So if I'm clear about that, so depending on the cost and the interest that I'm going to have based on the customers, what is the return that I'm going to have? It is a return that is basically depending on the money that comes in every month, the money that I spend in cost is finally going to give me a return rate for my projects or my business. So that's part of the previous speech. We're not going to go deep into it, but the first thing is that it is not enough to, okay, so the technical language of growth of startups in financial language that is going to give you security that they're going to believe in us and that we know what we're talking about. So it's not just about saying, "Oh, I think my business is very good because I'm in love with it. I have put all my heart into it." That's nice. That's part of the business. But now show it to me in financial terms. What is the cost of getting each customer? What do you expect to get from each customer? How many people go out of the business? What is the profitability or the return rate? So it's important to have this language clear first. And then when I already have the language, I know my business, I know what I have in financial terms and value terms, I know my income, the cost, the return, and then the negotiation begins. That is a very beautiful step. And there is a sentence that I remember that sometime once upon a time a mentor I had told me that things are worth what the market is willing to pay, not what you believe is the cost. So it is how to make this market be willing to pay what I believe uh, it it is worth. So there are important points here. In the first stages when I haven't tested anything, well, okay, ideas are good, but a lot of people can have ideas. It's important to start to test them and to demonstrate the value. So is once ideas are purchased. So the value of your business is going to start to grow once we begin to consolidate, to earn customers, earn market, and earn cash flow. And this is very important. There is not a precise formula to determine the value in early stages. That's why this sentence that says that your enterprise is worth what you and your investor agree that it's worth, and depend. So some of them might be willing to pay a little, some of them might say, okay, it's worth more, but depends on how much they're willing to risk. So there is an important issue of negotiation there. So within the rush to have capital fast, we must not become desperate. We must take it calmly. We must talk with many investors. And remember, the ratio of finding a good investor can be of 10% or even 20%. So you might need to talk to 10, 20, or even 30 investors in order to have enough offers to be able to make it. I remember many transactions I've been in which we have visits and we have these private capital or equity funds, and we visit 10 or 5 investors and we end up negotiating with one or two. So it takes time, and even more in a business that's not yet consolidated. I have had to negotiate with business that are more consolidated and with cash flow. But when they are more in an ideation stage, we have to talk with many people until we find the ones who might be interested. And for that, there's a whole ecosystem in which we start to make appointments and see for these people, find ways to get into the ecosystem. So we also have to know this technical language within the world of value assessment. So we already mentioned technical language needed in order to reach, uh, make the financial models and say my business is worth $1 million or two or 10. And once I have the value of my model, there's also a technical language for the process of raising the money that we are going to see it here also. We leave it here for you so you have it buried in mind and you can consult it. So we're going to talk about pre-money value assessments and post-money value assessment, that is after the investment. The pre-money valuation is how much is the cost of my company today without people haven't invested in it, and the post is what is it worth when people have already put money into it. And the investors use that language. They say, okay, how much is the pre-money of your company and the post-money? What is the dilution every time you receive an investment as a business person? Your participation in terms of shares is reducing because you are sharing those shares with the investor. That's called dilution. How much dilution do I want to have? And every time new capitals comes in, the initial investors are also losing part of their percentage of shares. And from then on, we're going to talk about this later on. There is the whole topic of the different rounds for raising capital uh, that can be done by an angel investor or venture capitals or more specific series that are called series A, B, C, until we can get up to get or reach the the trade, international trade. But that's what many people aim at. Um, but you do not need to necessarily to be there in order to be successful. But anyway, in the life cycle of a business as such, we're going to go now into valuation, and every curve. I think we have talked about this in different moments. We have all the part of the early stage of the company, the exponential growth that we are seeking, and finally the maturity, in which what we want to seek is for a stability, and sometimes there is a decreasement and we have to innovate again. So how are these flows? You can see what is most important here in the curves. The blue one uh, is cash in financial theory. There's a saying that says that the cash is king, cash is queen. So cash is the key one. The accounting earnings does not make a lot of sense, but how much money do we have on top of the table ultimately? So the businesses who require a high exponential investment need a lot of cash. There is no cash. That's the difference between the traditional business. The traditional model starts here almost in the zero axis and tries to sell what is needed in order to pay for the payroll and the expenses. And through the years, they save, save, save. And when they have enough money, they say, okay, now I can invest. I can have another business, or I can have another um, facility. But this takes 30 or 40 years. Well, in the digital business, given that I have to have this slope, this growth, exponential growth, I need to invest much more money in a more accelerated manner. And that's why the blue curve is the one that is below. And that is why I need money from investors. If you do not want to have this growth curve in such a short term as 5 or 7 years, it's perfect. You do not need to go and seek for it. All you can go and make your business at your regular speed that you're having. But what we are talking here applies for people, business people, who want to grow exponentially. And in order to do that, you need to do it with the money of somebody else. Um, because you might have your own money, but maybe you have already spent it in the first stages of the company. So what we're seeking now is how to inject fresh resources that cover this expense, making a bet to having a growth not only of the business, but accompanied by cash. That is the last part that grows. So what am I changing? I'm changing action, shares of my company, so I get the energy or the fuel to be able to grow fast. That's the trade-off. I receive cash and I'm going to have growth very fast. That's why we see here how it is diluted, how the participation of the investors are diluted. So I can have a business or an idea that is worth around zero because nobody has tested it. I'm owner 100% of the business. I have an idea, some things, a minimum viable product, wonderful, 100%. The owner, that's like the saying that says, the are you the head of a mouse or the tail of a lion? Because okay, I can be the owner, 100% owner, or something that does not have a lot of value. But what is the value? The value is what the market is willing to pay for my business. And as I grow, in order to have this growth, I need investment of money from other people in order to be able to invest and spend in what I need in order to have momentum to bring enough income and recover the expense per customer that I have used and bring enough income in order to generate cash.
compañía cada vez va a valer más.
But as this comes in, my company is going to be worth more money because I'm bringing more customers and more money. But in order to achieve this, I have to give away part of my participation, of my equity. So here I'm owner of something that is worth zero, and now over here I am already diluted, but and I have 34% of a company that is worth 3.6 million. So I have around $1 million as my equity, when at first I had nothing. So this dilution offers me the possibility of being owner of something larger. Now, if I do not want to have partners, if I do not want to be diluted, if I always want to be the majority uh, partner, maybe this is not the path to take. But if I want to get into this modern business of growing fast and diluting, but being part of something large, it makes the whole sense to do it. So there are many philosophical concerns here that we might also need to reflect upon as a businessman. Do I want a traditional business, calm, to do it the like step by step, or I want it more accelerated? And besides these flows, and for each of you who want to go into this, the investors who are here are going to start to ask. That's why it's important to have negotiation terms. They are going to start to ask for profit because they expect that in 5 or 7 years they can go out or sell or take it to the stock market. So they do not want to be married to the company for the whole time. So the pressure from the investors to generate fast cash and to comply with or fulfill those predictions that we have promised are really strong. So the business dynamic changes, and the business person must also know that that is something to expect. So I think we have a space for questions. I'm going to accelerate a little bit. These were some basics. And here, just to tell you that the basic equation of valuation, the first one is the evaluation pre-money plus the input of investment of a third party or amount of investment. This plus this is equals the valuation after the money. So it's pre-money, on the money, post-money, post-money. So pre-money is before I receive investment, is the valuation that we're going to explain briefly. So this is the initial valuation of my money. My money, I can say, of my business. So I can say my business is worth $100,000, but then there is an investor willing to put that same money. So my business cost is what it's going to generate plus, or the initial value plus the value invested. So in this case, it would be $200, 200,000. So if I want to know how much will the investor keep from themselves in the valuation, is not, it would be calculated upon the sum. So it's basically the amount of the investment that is going to be 100,000 over the total value. So if he puts 100,000 and my company was worth 100,000, he is staying, or he will keep 50%, or is his property, is owner of 50%, because 100,000 over 200,000 is 50%. And this is very important because we're going to see a model of evaluation that I want to know how much I'm willing to uh, give the investor. Am I willing to give away 30%? So I need to calculate the money that I need from him with the post money value to know if I'm going to be willing to give that investor 30% or 50% or 70%. You know, sometimes an investor might tell you, I put some money, but I want to be owner of 90%, and maybe that's not what you want. Now, what mistakes can we make in this valuation process? They depend a lot on the negotiation that we make. One is that you make it very early, very high and early. So I say, okay, this is a very promising business and it's worth a lot, but I do not have anything to show yet. Now, the other one is that I do not have how to validate it with customers. If I just have an idea or of a potential market, then it is difficult to demonstrate the value. That would be too high too early. Now, when I start to have more customers that demonstrate that they are purchasing, I have a higher capacity to do it. And finally, is to focus only exclusively on the numerical valuation, because there are other topics that we're going to see later on that have a lot to do and the investors are going to take a look at. So when we have a business that is demonstrated with numbers, figures, and customers and minimum viables, you have a greater capacity to take a look only at the numbers. But when we have a very early part of our business that is just an idea that you're starting to test, we must only not only take a look at the numbers or figures, but other things that are behind the people, the advisors, the boards of directors, the market, because that is something that the investor is going to pay attention to. If this person is going to is preparing for what they are going to do, and that is going to give or not give trust. So are there any questions up to now? Maybe in the chat, or you just open your mic and we solve them. Okay, so let's move on. Which are the easy formulas or accepted in the market in order to value your company? So we had talked about the free flow cash. We had a full session already in which we talked about how when one makes a financial value and projects the income and the expenses, taking into account all those terms, cost of acquisition, the lifetime value that I'm going to take out of each customer, we can determine that those flows and bring them to present value and to determine the exact value of the company. But remember that we said that in order to reach this stage, we already need a tested business. We already have to have figures in order to make the projection, at least assumptions. But when we do not have the assumptions, there is another way to do it. First one is to compare my company with other companies in the market. So to seek similar startups. This is done in all the industries, not only in startups, but it's good to know what is my industry. Do I have a niche or not? The experience of the founder, where is the company? Does it have momentum? Do they make B2B or B2C? What is stage? What has been the funding up to now? So I try to find companies that are similar, and I make an additional profile, risk profile. So if my company is newer, maybe it is worth a little bit less. So I can tell you, hey, I have these 10 different companies that I consulted that are worth $10,000, and I have a similar market, and I consider my company is worth the same. And third is where the negotiation begins, because the investor can say, but you have not demonstrated results yet, and you start to negotiate. Another one that is more accepted is to make a scale to rate the most important factors of your company, and each step is worth $250,000, because that's how the market discusses it. So this is already standardized. So, okay, if you fulfill all of this, your company might be worth $3 million. But if you do not fulfill with all these checklists or comply with it, then you are going to get up to the point where you're shown here in the graph. So for example, your market size is greater than $500,000, the scalability of the business model, the founders have experience, there are more than one founder committed full time, the MVP is developed, you have business model is validated by customer, etc. If all of them are checked, then your company might be in the order of the $3 million. Usually when there is a relatively mature startup, this is where when they invest before going to the stock market, or else they will invest less, a million or 500,000. So that's another way of discussing. So that's why we said we showed this image here that your enterprise is worth what you and your investors agree. If you know you have a good business, then you have to put the value and challenge it. That's why it is important to have a coffee with a lot of people, because you challenge the value with investors that are going to tell you more or less how much can it cost. No, now there's another one, and this is more subjective, and is that each person offers puts the value to it, and it is that I create a list of all the achievements of my startup, and the I bring the different capital, technology, execution, market, and take I pose a value for each of these, and the sum of all of them is going to be the total sum. This is similar to the one of steps, but this one, I'm already putting my own value. Like, I have invested so much money, $100,000 in my company, or $50,000 in the last 2 years of work. Technology, I have purchased this and this. The market can cost X, and they have these costs or expenses. That in order to recover them, I need X amount of money. So in total, my company, from what I have invested and what I haven't and what I know it's gonna give me in the short term, is worth 100 million dollars. So this is an estimate with a business based on business experience. And when we do it, when we have a mature company based with a value based on fluxes, it must give a similar amount than this one, than the risk mitigation. Now, this one is very beautiful. It's the quick venture capital. Is that I value the company depending upon the amount that I will need in the following months, and depending on the maximum amount that I want to give in return to the investor as my partner. So here is where the formulas of pre-money and post-money come in. So I'm gonna toss the floor to my dear Catherine, that all of you know, so she can explain this in detail, so you do not get bored of listening just to me. But in essence, what I say here is, okay, I know how much I need as a company. I know I need, in order to cover my operation expenses and my investment in marketing and my purchasing several devices, I need this amount of money for the next year and a half. So the gas I need, the energy I need to, this is the fuel I need to burn in order to reach certain level of sales. And I am willing to give, due to that energy, for that exchange that I'm going to do with the investor, I am willing. Remember, we talked about an exchange. The investor gives me a fuel, that is the energy that I need to grow, and I give them back a percentage of the company. So for that percentage, for the next year and a half, I'm willing to give you 10% or 20%, because I do not want to give them more, because given that I want to grow so much, I do not want to give them all at once, but I give them a percentage so I can go to other further financing roles, and, and I have more opportunities then. So how much money do I need? How much am I willing to give the investor in percentage of my company? And I use the formula we showed here, the formula of pre-money and post-money investment, in order to determine exactly how much should the value of the company be. So I wonder, Catherine, if you want to explain this formula in detail. Is Catherine around, or did she fall asleep?
Bueno, parece que Kate se me fue. Vamos a despertarla por aquí del celular.
No, ya, volví, perdón.
Ok, dale.
I'm
¿Me
here.
quieres ayudar explicando esta fórmula para que tengan
So,
todos
do you want to help me
una
explaining this
una
formula so you listen to a different
cómo
voice,
funciona la fórmula que ya la explicamos?
women's voice, and you tell them how does the formula operate?
Quick VC, ¿estamos viendo así?
Sí, quick visit.
Quick VC, yes.
Listo. Entonces,
Yes, good. So this is a valuation method that is basically fast of venture capital, and it consists, or our goal with this is that what we want to know is what is the cost of our company today. We're going to start from, given, if you have seen a Shark Tank, one of these programs, they always talk about, okay, I asked the sharks for $2 million for 15% of my company. In this case, it is something very similar. As you can see here, I see, okay, first I estimate how much money I need for X horizon of time. Here we're talking about $3 million in this example to cover the next 18 months. And the second step, I have to understand, of course, with the investor, how much ownership does the person want to have of my company. So in this case, we say 20%. And based on this, we're going to calculate the post-money valuation, which is the value after the investment. How do we do it? With this formula that we already saw some slides ago, we take the $3 million that the investor is going to put divided by the percentage of ownership, that in this case is 20%. What is the result? $15 million. Now, this number is useful for, or what does it mean? That my company today is worth 12 million. Why? If you remember the equation, the basic equation of the valuation that Mateo showed you, you can see that it is my post-money valuation is equal to my pre-money valuation plus the uh, investment input. So what we are doing in this method, if you can switch to the other slide, is basically to solve this equation in order to have my pre-money valuation, in order to know how much my business is worth today. So I take those $15 million, that is going to be the cost of my company after the investment, and I subtract the input of the investor, and I will have this $12 million that is the current cost of my company. And as you see, we have many different methods to do this valuation. There is not a precise formula. So that's why having these different methods helps me compare between them and to realize if I am far away of the market or of the competition, or if I'm in good shape and somebody is going to be willing to invest in my company with that initial valuation. Very good. Thank you. So what's beautiful about this level of valuation is that I can tell what is the cost of the companies in the market and what is the subjective value that I can state depending on what I invested. And this one is beautiful because it has clear numbers. So it is, I sell my company to you depending on the expenses that I'm going to have. Given that I need $3 million, I'm willing to give 20%. I could say that I'm willing to give 50% also. That is part of the negotiation. If so, those $3 million in this case are 20% of my company. So I tell you, you're going to earn 20% if you give me $3 million. And then I have more money. Why? Because I'm going to have higher sales, because of course in the document of the memorandum information and investors deck that we have mentioned also, I have to tell, like, given that I'm going to spend this $3 million, how much is the future income that I'm expecting? But we can see that here I'm not valuing the present value of that future income, but I am going to have to demonstrate it, because the person is going to say, okay, I'm going to put $3 million, you're going to give me 20%. And what happens afterwards? Well, I have to tell them, okay, I'm going to have this income. But the value, I'm not doing the valuation based on the income, but on the expenses. Okay, but the expenses have a relationship, but do the expenses because I'm going to have that level of income. That's why I have to have the full document when I present it. But here, at least we have an initial specific agreed value to it. And then we move on to the next method that is the most sophisticated one. And it is when I take into account the income and the expenses. So I say, okay, if in the following 7 years, I'm going to have this level of income and the level of expense,
En valor presente,
the
teniendo en cuenta
subtraction of both in present value, taking into account the interest rates, means that I expect that this company is going to cost or costs, because if these flows come in 7 years and I have these expenses, this company is going to be worth 10 or $15 million. And there it is, how much am I willing to give in exchange for capital investment or equity. So that's what in this one is where we need more information, but each of them become more sophisticated. And this one over here, we have two additional methods that I think thought important, sorry, for you to know. This is similar, the one of market multiples is similar to the previous one of comparing your company with different companies. So for example, when there is a company that we already know, such as Twitter or Facebook or a smaller one, if we know the EBITDA and how many times, it's a comparison by multiples. So my company is worth 2 times the EBITDA or 3 times the EBITDA. So we go and seek for these companies how much time have them been valued. For example, the valuation of Facebook is in 10 or 20 times. In company, so my EBITDA, which is the operational utility before depreciation is called similar, a similar multiple, time 8 or 10 times the EBITDA. It's a, it's a fast way of evaluating. And the one based on assets is more for the real estate sector, where when I talk, depending on the investment, how much is the reposition values. If I have invested $2 million, that is the cost. But I think this one does not apply a lot. But then it's all anyway, it's good to have it and to know what it's about. So we cannot just stay with the values. We must be clear about this. What does investors look at? What do they look at? Not only this cash flow. This cash flow is a promise. If we're standing up here, we have been just working for a year, and we are showing an Excel sheet saying that we're going to have an exponential growth, such as this one. We're standing here and we are telling them, okay, we're going to have this whole growth, but we have done nothing. We do not have a cash flow. The investor is going to say, okay, and or they're going to ask how we're going to achieve that only with my money. No, so you need to have these other documents to explain very well who are the founders and the team. That is extremely important, to be surrounded by good people, not only the founder, because usually the founder is more lonely person that has done it by himself or herself, that does not have anybody to talk about their pains. And that was my experience. That's why I tell it. Uh, that curriculum vitae is important, but it's also good to be surrounded by people who believe in your bet, who are your team. And additionally, to have advisors as board of directors, you can call it like this, or advising board, or however you want to call it, but people with experience that are there giving you feedback, and that the investor feels that that you are not by yourself. Now, other things to take into account: who is the competition? Is it a new market, or is it a market that already have people there? The incumbents already own the market. What is the size of the market? How is the client momentum generated? This is about knowing the business, explaining the business. What is the projection of income that you have? If you make a quick VC method, as I said, okay, I bring you this money and you give me 10-20%, but how much am I expecting? How is this monetized? There is a case of a person that I know that was clear on the amount of investment, and went to the board to present what they needed. And the board, who are people that are elder, okay, this is good, you're going to spend all this money, but show me how are you going to monetize it. And even though they had been working for a year, it was a very serious team with advisors and consultants and everything, that they did not have clarity about how they were going to monetize this. How was the projection of income? They did know that they were going to sell some things, but this was not grounded. So they asked, how do you intend to spend $2 million if you do not know how you are going to recover that money? You know, so they did it in the traditional way, but they told the investors, told them, hey, we give you money, but if you demonstrate how you're going to bring it, and if that it is credible. Now, intellectual property and the technology used. Do you have the technology, disruptive technology, or are you developing? And the intellectual property. And finally, the potential of exit. Uh, Exit potential, this is like having a chicken and feeding it and selling it. That is the way they think. I buy something that is still like young, and I feed it and I make it grow, and I offer advisory because the investors come in and they control and they bring experts to advise you. So when it is already grown, they go out and sell it. Or that the business person stays and the investor leaves with their earnings, and then can have a different investor, for example, a stock market investor, etc. So we have to have all of this in a document to show it, in order for the investor to want to do it, because it's not only a promise in an Excel or in a paper, but that additionally there is a team committed to it, with advisors, with experience, with a market share or size that is attainable, and with income that is viable and feasible. And besides that, when this is in this level, we're going to be able to go out and sell it and have an exit strategy, as is called in the United States. Good. So we already have the value. We calculated in a way. We have the differentiating topics, and now we have to go out there and to make financing rounds. So here it's important to be clear, to understand that this financing work when the idea is still raw, when we do not still have a lot to show. That's why usually these first rounds are with the family, friends, and uh, fools. Family, friends, and fools. The innocent ones, the naive ones. Who is going to offer money? Because we still do not know if we're going to have enough capacity to generate this. But when we already start to have a business that we generate, that it operates, we already start to talk about more sophisticated investors, which are angel investors, which are not the family or friends or fools, but people who are willing to put money, important amounts of money, such as $100,000. So we already start to talk about 1 million or $2 million, which are venture capitals, or these are the most sophisticated ones. These equities, they are the ones who request these documents with technical languages, and they are looking at many different possibilities for investments, and they are aiming at returns of 50-60% and liquidate the investment in 5 or 6 years. So they create equities with people who have enough money, and they put their investment in different opportunities. Many of them fail, but if there is a portion of them with high profitability, that is their business. 7 years from now to draw out their earnings and to earn more than what they investment. And that is what they call Series A, Series B, Series C. So I grow, I'm making my first series. So that's why it's important to know the percentage I give to the investor, because if I want to continue growing, because I can say the next 18 months I need $3 million, but there I have not reached the exponential level of growth or the coverage of the market. But it is the first one. I cannot go and ask for $20 million in the first time. So I need to say, okay, 20%, and I scale up. And every time I do a series, I am going to offer an additional percentage that is going to dilute the owner, but it can also dilute the original investor that the person is willing to in order to continue growing. And finally, there is one that is called the initial public offering, that is an to go out to the stock market, that is kind of the highest level expected, beyond being beyond a unicorn and a company with a value of higher than $1 million, and it's a different kind of creature, you know. So that's how the rounds work. So here we have this graph that is says what I just told you. The family and friends are over here. They put money. It's not a lot. I am validating the business. And when I have already validated the business, some new funds come in, different funds. This one that I did not mention, this crowdfunding, like a lot of people funding company directly, not only just one or two investors, but many putting a bit each, and the total is big, or the angel investors, business angels, and then to go into third-party money. There are people who are not related to us, and finally up to venture capital and stock market. So that is a long trajectory that constantly needs, when we said at the beginning, it's a permanent job that I permanently need to work in order to get this capital. I make the first round, I run out of money the next year, so I do other rounds and grow until I reach stability. Now here, just to fund sources of financing for growth, we have three. One is traditional debt that we put in here, but usually in the first early stages, there's not a lot of debt because there's not capacity of payment or guarantee. But usually where we do have them is in equity investment. That is what we have been talking about equity all the time. This is capital investment, or a combination that's called mezzanine, in which it is a combination between traditional debt and equity. Equity is basically that I purchase with my counterpart of what I put. I receive equity, capital of the company, 20, 30, 40%, what I decided, and I am kind of an investor of the company. When I do equity, and this have some conditions, it does not have guarantee, does not have grace periods, long-term horizon. I can have strategies of exit to sell to third parties, etc. I'm just a partner of the company with some responsibilities. In the mezzanine, it's a mixture. So I put, for example, the $3 million that we talked about, I put one part, like half, 1.5 million are shares for me, and the other half of the company should pay it as a debt. And I can determine that that
condiciones inferiores a la deuda tradicional
can
de
have
crédito.
inferior conditions lower to the traditional debt of the credit market. So if in the market it is 10%, I can be willing to receive the payment not in 5 years, such in the market, but to be paid back 8 or 10 years afterwards with better rates or with guarantees or not. It's kind of a funding that is similar to the equity, but it's repaid. The equity is not paid. It's only paid when the investor goes out and sells. So he got rid of the investment, but sell it to other one, or the business person uh, purchase it back. But the mezzanine is a mixture. Part of it, I am owner of it as a partner, and the other part is repaid as a debt because these funds want to have certain guarantee of cash. So I lent 3 million, but then it's a part that comes back as a debt, and I am owner of the other part as a partner. What we need to understand this concept of mezzanine. Remember that the mezzanine is like a when we have a room and there is a midpoint that is not a full store. So it is not debt or equity, but a combination of both. Good. So then we are already into negotiation. So in order to go into negotiation, there are things that I already have to take into account. I have to take into account my valuations that I have already done. There's one thing that is called the term sheet. That is basically the document where all the conditions of sales are. That is very important because we do not only have the value, but we have the rights, the controls that I'm going to have. Am I going to have a financial person? Who is going to control the money? Who can I uh, share the dividends? So the agreements of negotiation that is not yet the sales contract, but when we sit down to negotiate, we make a document such with bullets, checklist, where I say, okay, I'm willing to uh, compromise here, but I'm gonna still be the manager, or we're gonna have a double signature or shared accounts, or I must do an SPD or open a fiduciary or a trust, or can I share dividends? What is the wage of the entrepreneur? Is not only the value, but the commitments that are going to be there. So these conditions of agreements is very important. And that's why we later are going to say things. Maybe I'm going to jump up to here. There are things that we cannot, that are non-negotiables. I need a lawyer, for example, in the transaction. I need an accountant or a financial person to do the figures, and I need a mentor with experience. That's why this having the board of directors to accompany in order to do the negotiation is very important. So I need to be surrounded by a lot of people because remember, you're selling your business idea, your creation, your innovation. So you need to be surrounded by people to help you uh, give confidence, because here we are offering you the first steps so you know the panorama and you know who should you be surrounded by, because the idea is that not that you know everything, but you are always very well surrounded. So in these factors of negotiations, you have to have the term sheet very well structured to know and be clear as to how much money has already been invested, because you're not going to negotiate less than what you have already invested, and to be clear, and we have already mentioned this in the beginning, what is the stage of the business and what towards the future, because we cannot uh, give the business now if you need more space in the future to invest money. So if the investor who purchases 90% does not want to put more money, the business is going to be run out of fuel. Good. So those are the topics of negotiation. So I come with my value. I reach an agreement with the investor about the conditions. And why are the conditions important? Because what do investors seek for? The investors, many of them want to have a position on the board. They want to have the CFO or the COO. They want to have shared businesses or services in order to save costs, and that through their financial groups they can operate this in order, instead of you having your own human resources, etc. They want to have permanent reports. Maybe you're not used to this, but they want to have financial and impact reports to know if the company is doing good or doing a good job, and they classify the kind of investment depending whether it's equity or debt, where it is, where they're investing. Are they having social impact or only financial impact? What are the sectors are they in? What is the size, the permanence, the interest rate? And that's why it is important to be very clear about what you are willing to give. It's not only sharehold, but the management of how you manage the funds. What are you willing to give? So how to find them? I were already repeating to have a pitch. When I'm seeking for investment, I am giving participation to a third party that generates responsibility, not only of offering the results I promised, but it is a business as such. It generates responsibilities that, such as sharing information, co-managing the company. It's not just me as the only businessman, but I already have other people who are looking at me, and must be willing to do it in a good way in order not to get in problems and suffer for this, and knowing that conditions are going to change. It's important to know this. So coming to a closure, it's important to take into account that the investors have rules. They do not only put the money, but the money is accompanied by rules of operation of the company and expectations about the time they want to be there, and also with a kind of impact. And this is different. We can seek for investors who are mainly seeking for financial profit, that are on one side of the spectrum, but there are also more philanthropic investors or intermediate investors, that they do not only want companies to have financial impact, but also to have social or equity or women inclusion or social inclusion topics, and or that are concerned about environmental profit and community profit. So that's also an added value. So depending on the kind of business that we must know what investors will we look for. So if we have a business with a lot of social impact, we must also take advantage of this as a plus to receive money at a good cost, and not only we must be clear in this. So this is a list of startups that have gone through in Latin America. They have gone down this way, and they have been able to raise different kind of money in rounds, and that have been in valuations of over $200 million. Like a unicorn is over $1,000 million. So when we are valued by this, because we have enough flow, and despite we are valued in this amount of money, you can be valued also. And here it's very important that the finances of the startups are wonderful. We can be here. This is a point here. We're investing. We have a market. There is growth of the company, but still it is not giving profit or cash. But I am valued in 1,000 million is because we have demonstrated that this is true. It's a matter of time to know that we are going to reach here. And this point, this cash is the one that is worth $1 billion. So not necessarily the companies that are valued in that level are already in that maturity. They are still growing, but they have been able to demonstrate that they have the capacity and the drive to go there. So that's what happened to this company. If we take a look, for example, at Rappi, this company that is in Colombia, Mexico, and Brazil, they have not been able to go to the stock market yet because they do not have enough cash. The mass is still growing, and maybe they will get a moment in which they are finally sustainable. That also has to do with the crisis in the startups digitally, is that in the market wants real resources, not only in paper. And that's why many, given that the interest rates raised, given the future fluxes that are the ones that give value to the company become smaller. And when they are smaller, the companies are worth less. And the people say, okay, my company is worth less, my investment is worth less. So I need a more precise demonstration of the value. So it is very important to study the history and the results of the ones that have been successful. And that is going to help you a lot in your illustration. What else do we have? It's very important to read a lot. Here are some sites where you can find interesting things that are going to help you. And what I also said before, you need to be very well surrounded. You need to experiment with detachment. It's not just the first one who makes you an offer, and to think with abundance. It has to do with motivation of how I want to grow. So I think that with this, I'm closing. Daniela and Kat, it's important here that with the final reflections is that each has a different path to go. That is like the normal path. When we climb mountains, we normally talk about the normal path, the traditional path to get to the summit. But then people start to seek for different routes, some easier, some harder, but there are many different paths to reach the same summit. Uh, so can we reach that moment? And each one has their own way of doing it. So that path has to have a balance between the family and the person's the personal dimension, and with a lot of focus, everything will you will reach the goals. And what is important is to enjoy the 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 path, and to be able to celebrate the good moments and to overcome the difficult ones. So this is kind of uh, an intention to tell to let you know if you're interested in raising capital, to let you know what you are going to find on the way. So we're open to questions or comments.
Listo, Mateo, muchas gracias. Veo
Well,
que
thanks a
hay
lot, Mateo. I
varias
see that
preguntas.
there are already a
Las
couple of
primeras
questions. The
preguntas
first one is of
es
Marlene
que
Miranda.
hablemos un
She
poquito
asks us to
sobre el tiempo
talk a
que
little
se
bit more
demora
about
estar
the
listo para el
time
negocio. Me
that
imagino
the
que se refiere
investor wants to
como
be in the business.
como
I
al
mean,
punto de
I
salida
imagine
que busca el
that it has to do
inversionista
with the exit
en
opportunity for
startup.
the investor in a startup. Yes, usually the equity funds have an average life of 7 years with a maximum of 12. The kind of this is more or less a good long-term investment. So an equity says, okay, we're going to invest. We need enough time for the company to grow. That is more or less 3 to 5 years, and they know that after 5 years they are going to start to see if they can exit, because given that they are an equity in which different investors, institutional or investors or natural persons put money, this is like an investment that is after 7 years you get acidity, so you do not want to be there all your life, but after some time you want to take your money out. So Kate, please mute your mic. So they follow in the following 10, 6, 5 or 7 years, I'm going to invest money, but I'm going to put a financial person. I'm going to ask for reports and numbers and figures, and I'm going to press because I want to leave in 7 years from now when I exit. And within the conditions of the term sheet, they say, okay, if there is an offer, you also sell as a businessman. You must know if you want to sell, or I sell and you stay. So there are many conditions that we must be clear about regarding the capital funds or the equities before embarking on with them, because they do not want to stay there all their life. But the average, so you're clear, is 7 years. And normally the 7 years are not fulfilled totally because the market conditions are not always ready to sell. If somebody wants to sell a business nowadays in the startup crisis, no, it's better to wait for the crisis to go by, and maybe we must wait 2 or 3 years more. So it's not 7, but 10 or 11. So, but the expectation is more or less around 7 years. I think there was another question. Yes, yes, there was. Yeah, the books. Where can I read more? We already showed some books in one of the slides.
todo este tema lo pueden encontrar. Hay unos libros adicionales que no pusimos acá,
And
precisamente
there are some additional
hechos
books that
para
are not
eso.
here. We have this one that
Muchas
got
referencias.
we have lots of reference
Startup
there.
Valuation.
The
Startup
startup
Valuation.
valuation.
Hay otro que se llama también Term Sheets. Están todos en Amazon.
All of them are
Déjame
in
te lo
Amazon.
muestro acá exactamente cómo se llama. Los tengo aquí en Kindle y todo. Eh, espérate a ver. Mira, hay uno que se llama Raising Capital, Angel Capital. Otro que se llama
So we
Term
have
Sheets.
this term sheets, angel
Son los
capital,
documentos para poder
term sheets
hacerlas.
that are
Startup
documents.
Valuation en Amazon y ahí te encuentras una cantidad interesante de libros y libros que son chiquitos y fáciles de
So
entender.
there are many books that you can
Ya,
find in Amazon. There are some that are really
hay muchas
easy to
también
understand and
para
fast to read.
por Kindle. Hay
In
muchas
Kindle,
cosas
you can
ahí,
find many, you know,
pero
$10
acá
books. There are
lo
many
más
things
básico,
written about
lo
this.
más
What's
básico
difficult
es que
here
para
is
mí
not to know where the information is, but the challenge is in
se le caen a uno, al final uno se pone de acuerdo en el
knowing
precio
how to
y
do it, you know.
la plata que le van a
There,
dar.
I've been in
Entonces,
negotiations of a year and a half that
uno
finally the
está
term
pagando
sheet,
dividendos, usted
there's
recibe
no
los
agreement
dividendos
reached.
y a mí me
For
dan
example, they say,
como
okay, we want
comisión
to
adicional. Entonces,
sh
hay pujas, digamos, entre los
share the
inversionistas
dividends, and there are
y
negotiations
el
between the
tercero
investor and
y
the
uno.
entrepreneur. And
Y
sometimes there is a
uno
hard
también hacerlo de
negotiation.
forma
And there might
equitativa
be ego,
y
not negatively, but there must be like an
y
ego that say, I am
recibir una
the
oportunidad de la vida.
entrepreneur, I'm making all the effort, and you're asking much
Eso es lo que
more
buscan el inversionista.
than I'm
Entonces,
willing
por
to
eso es
give.
que
So that's what the
uno
investor,
trata de tener ese
the
equilibrio.
investor
¿Cuál
also
es mi
wants
esfuerzo y
to
cuál es mi propósito?
earn
Estoy dispuesto a dar una plata
significantly.
o
So
puedo
what is my
ayudarle a
bet? Am I
alguien
willing to
a
grow?
crecer
What am I
y a
willing
sentir feliz?
to
Eso es lo
give
que uno hace
away? And who am I going to be
para generar
happy in
resiliencia
sharing this with? So that's
financiera
part of the
y
resilience that we
también
must have throughout all the process of negotiation to raise the
listo.
money. To raise the money, yes. Okay, what else? What do we have here?
Listo, creo que en el chat veo una pregunta
Puede
como de follow-up
recuperar el
de
porcentaje de la
Marilyn.
So I
empresa.
see a question in the
En este
chat.
caso puede recuperar el porcentaje de la empresa. Donde, claro, digamos, la venta, uno
Yes,
puede,
so okay.
hay
The
ecuaciones de
there
negociación
are
en donde
negotiation
uno puede decir, vea, señor
equations in
inversionista,
which
en
one can say,
5
okay,
años le
Mr.
encuentro
Investor, in
un
5 or 7 years, I will
esos 3 millones de
repurchase what
dólares
you
y
invested.
le
Give me
pago y
this
le
$3
doy el
million
$20%.
and I give you
Y usted a
20%.
mí la
And I
primera
tell you,
opción, yo como
okay, give me the
empresario,
first
deme la
option. I,
primera
a
opción
business
de
person, give me the first
recuperar
option
el
to
valor porque
repurchase
se pondrán de
in a
acuerdo
certain
en
value
5 años.
agreed upon in 5 years.
Si ya la empresa ha
So
generado tanto
if the
dinero
company has
y ha
already
generado pérdidas,
generated this much money and you have this much
entonces
personal money because the
esa
dividends, you
persona,
have the
usted puede
dividends,
recomprar
you
y
can
ya pues no le va a pagar 3
repurchase
millones de
and
dólares, le pagará 3 millones de dólares más lo que se ponga de
then
acuerdo
you are going
en la
to
venta, en la
earn
compra,
or
lo que
pay
sea.
$3 million
Termina
with
siendo, no
the
sé, 5 millones de dólares.
return. Maybe you end up paying $5 million and then you repurchase your company. That's another way of doing it.
Entonces, o la recompra usted o
Or
usted
you repurchase
busca
it,
otro
or you
socio para que
seek
le sea de su
for a
negocio
different
y
fund.
se la recompre.
So they are
Eso
your
es una
partners and they
posibilidad.
are the ones who repurchase it. There are many ways
Sí,
to
eso
handle this
es una vía.
afterwards. But yes, that is
Listo,
feasible.
buenísimo. A
Very
ver,
good.
ya nos llegó otra pregunta por acá. Anónima dice,
So
apenas tengo
there's an
noción de
anonymous question
desarrollo
here. It
en una
says, okay, I
forma
have an idea
digital
of a
de
digital
emprendimiento.
business
¿Conoces alguna
related to
forma
women, but
o
I'm not being
fundación
able to
de
ground it. Do you know of
ayuda
an
a
entity
iniciar
that
este
can help me
proceso?
shape that
Entonces,
idea?
ahí poníamos en muchos poníamos
Well,
que el tema de
in
Endeavor es una cosa
Endeavor
entenderla
is
ahí en
if
internet,
you can
donde
seek
da
Endeavor in
recursos y
internet,
donde invita
where
a la
there are
participación para precisamente
there
ayudar a
is
los
an
emprendedores
invitation to participate to
a
help
armar las
people
ideas y a participar
craft their ideas and
y crear
participate and
proyectos viables. Entonces,
make feasible
ahí es
projects.
una buena
So
forma de empezar.
that's a good way to begin.
A ver, ¿quién más? Priscila, CEO
Okay,
de
who else?
emprendimiento.
Priscilla.
Priscila nos está contando un poquito de
So
su proceso
Priscilla
de
is
emprendimiento.
telling
Le voy a
us
poner el
about
chat para
her
que lo
product, her
puedan
company.
ver.
So I'm going to put it in the chat
Y
so you
bueno,
can
si
all
alguien más
see
tiene una pregunta
it.
o
And if
comentario,
somebody
pueden
else has
colocarla acá
questions, you can raise your
para que
hand or
podamos
send it
responder.
through the Q&A and through the chat.
Ese ejemplo de Priscila está muy bueno
That
porque
example of
ahí
Priscilla is
tiene unos
very good.
componentes adicionales de impacto
So here we have
ecológico,
additional
social,
components of ecological and social
que
impact
tiene que uno
that
tratar
one
de
has to
comunicarlo
try to use
que no
in
solamente es
your
el tema
pitch.
financiero, sino
That is
también
not
el
only the
impacto que
financial
uno está
topic, but
ocasionando.
what
Mucho
you
de los
are
financiamientos
helping or
se
adding
están
value to.
haciendo
Many of
fondos
the
bancarios, se están volviendo importantísimo toda la
banks
componente de
uh,
que llaman
are
ESG,
also giving a high importance to the
environmental,
ESG,
social
environmental,
y
social,
governance.
and governance aspects. That is, that one is concerned for all of these topics and inclusion and social topics and governance to have a good corporate governance with transparency and responsibility. So these things we must also have it within our story, the story we tell when we talk about our company, because bankers and investors are more interested in this every day. Good. So I think we are reaching the end. Everything that's good comes to an end. So we can stop here. And I wonder, Daniela, if you want to say something to close and say goodbye. Well, Catherine, given that I'm recording Portuguese,
Sí, no te
you
preocupes.
can do
Bueno,
it.
entonces
Okay. Yes, good. So for now,
hacemos
I
una encuesta para que nos
leave
cuenten
you
cómo fue
here
su
the
sesión
link
de
for a
hoy,
survey so you can tell
que
us
nos regalen sus
what do you think about
comentarios
today's session and
agradecerles como siempre
offer our
por
comments. And of
estos
course,
espacios que son súper
uh, thanks
enriquecedores
for
y que
connecting to these
nos
enriching
ayudan a
spaces. And
compartir
thanks
estas
to you, Mateo,
experiencias
for
tan
sharing
chéveres.
all of the knowledge, your knowledge with us. Thank you very much. Good luck to all. And thank you. Bye bye.